everyone to Talk 30, where we make conversations about money. Please mute, guys, where we make conversations about money, wealth, and financial growth a little more sexy. If we spend just 30 intentional minutes talking about credit, real estate, insurance, investing, or business, we can start building the knowledge and strategies that create generational wealth for our families. So tonight, we're joined by AnnaBelle Simms, a wife, mom, one of my go-to mortgage brokers, and a real estate investor who helps people use their homes as a powerful financial tool. AnnaBelle truly makes mortgages as simple as A.B. Sims. Thank you, AnnaBelle. Welcome.
Thank you for having me. And that's my tagline.
I know, that's why I said it. So most people buy a home and think the journey is over. They plan to make payments for 30 years until the house is paid off, but your home can actually become one of your most powerful tools for building wealth. So today, you're going to tell us how. So
All
I'm
right.
going to start by asking some questions. I'll open it up for others if they have questions as well. I like to get right into it because it's only a short time. It's 30 minutes, right? So I want everyone to get as much value as possible. So what exactly is a refinance and why would a homeowner consider doing one?
All right. So refinance is you already have an existing mortgage. You already own the home and now you want to go back to either lower your interest rate or to take cash out of the property, right? Real estate is one of those assets that appreciate the fastest other than stocks. The market fluctuate, but it is something that I've seen many millionaires use to build portfolios and to build the assets that they have. So refinance again is just once you have an existing mortgage, you are either going back to the bank to say, hey, I want to lower my interest rate because rates have fallen, or I want to take some money out of my property because it has appreciated since the time I bought it.
Okay, and yes, we normally tell people that property appreciates at an average rate of 4% per year, which like how many other, things out there appreciate at such a high rate? Not that many. And in the past few years, we've actually seen it, be much higher. So what needs to line up for someone to qualify to refinance and what are lenders looking for?
So if you're refinancing just for the interest rate, of course, right? It's to either lower your payment or lower the interest that you're paying currently on your mortgage. So we have different type of refinance. You have rate and term, where again, it's just lowering your payment. You're not taking any equity out of your home. You just want to save more monthly in terms of your monthly payment. That's one form. And then the second type is where you would be refinancing to take cash out. So for example, my first home I bought for 168,000. Today it's worth 400,000. There's equity that is built or in that property. And the equity is what is the difference between what is currently, appraised for or worth less what I owe. So of course I have a lot of equity there. So now I can go to the bank or to a loan officer like myself and say, I want to take money out of this property because here I have a property with equity and it's not doing anything. So I can take money out by doing that refinance.
Okay, so you talked about the rate and term, right? As far as lowering the rate so that you can pay less monthly, but there's also the possibility of maybe you don't want to have it for 30 years. You know that you have some extra money, so then you can also move from like a 30 to a 15.
Correct. So you can also use refinance to cut down on the time that you have, but it needs to make sense, right? Because I always say, don't just refinance because I want to go from a 30 to a 15 year, but there's no difference in the interest rate. Because then you could take I could just do an amortization table for you. You take the difference of what that monthly payment would be and just dump it to the amount every single month, rather than doing a refinance. Because refinance comes with also closing costs, right? It's not the same as when you bought your first home or when you bought the home, but there's still closing costs associated with that refinance. We have to, in some cases, do a new appraisal, but we have to, for sure, get title updated because we have to tell the title company or we have to tell the bank, hey, we're going to be paying off this mortgage So that has to be recorded, and we're going to have a new mortgage, and this is who we're going to have it with, and this is how much it's going to be for, right? You definitely want to pay that money to get that title updated. Otherwise, when you go to sell and they have no records that you did this refinance, you're going to have issues in selling. So those
Oh,
are
that's
some of the closing
right.
costs.
Yes. And if you live in New York, there's always mortgage tax.
Yes, mortgage tax in New York.
Yes.
Now, if you go back to the person or if you go back to the bank that has your current mortgage, we can do what we call a SEMA in New York, which saves you some of that mortgage tax.
And again, with that, it is not always the best choice because sometimes it might cost you a little bit more money. So you always have to kind of go and evaluate the cost before you do it. Like you, for instance, mentioned you had someone that wanted to do a cash out refinance to take 20,000 the other day, but it didn't make sense
It
for
doesn't
them.
make sense because you're paying $20,000 in closing costs to get 20,000 out. And that person also had a 2% interest rate. And now I'm going to be giving you an interest rate at 6%, which is going to triple your payment. It doesn't make sense. So when you're doing a refinance, you want to talk to the experts, and Fannie and Freddie Mae, the people who make mortgage laws and rules, have said if there's no benefit to the client, it should not be done.
Right. And that's just using someone that's ethical as well, making sure that the person that you're using is not just forcing you into a deal so that they can get, paid on it, but they want to do what's best for you. So thank you, AnnaBelle.
Of
All
course.
right. So we talked about some of the different types. So what's the difference between doing like a cashed out refi and then taking out like a home equity?
So a cash out refinance is where you're going to refinance the entire mortgage, right? So when COVID hit, a lot of people that bought their property back then got the 2% interest rate and the 3% interest rate. Now, if you wanted to say, hey, AnnaBelle, I want to do a refinance to take cash out of my property. I want to take 100,000. Now I'm going to be taking what you owe on your current mortgage. So let's say you owe 100,000. I'm going to be giving you 100,000. Now that's 200,000. So I'm doing one loan for 200,000. So I have to refinance the entire amount. So you're going to end up with an interest rate of 6%. So you're going to lose what you currently have. That's the cash out refinance. If you take a line of credit, you're going to keep your existing mortgage, and then we're going to give you a second mortgage. So now you're going to have two payments you're making every single month. So you have a line of credit that you can tap into. And when you think line of credit, think credit card. I always say it's like you're getting a credit card that is secured by your home. Simplest way. Now there is also HE loans, right? Line of credits are called HELOC. There's also HE loans, which is you're taking just a second loan on your home. So it's a second lien as well. So now you have two loans that with regular monthly payment that you're paying. The HELOC or the line of credit, it fluctuates, right? Again, think about your credit card every month. Sometimes your payment is 35, then it's 45, then it's 60, depending on how you use it. That's the difference between the HELOC, the HE loan, the cash out, and we have so many different names for them these days.
Okay, so if I'm thinking about doing a cash out refi, are there any limitations on what I can use that money for once I cash it out?
So it depends on the type of property. If it's an investment property, you're supposed to only be taking money out to buy other investment properties. So business purpose. If
Mhm.
it's a primary home, there's no limit. Education you have kids in college, you need to do that. Repairs to the home. You want to buy another property with an investment, or you want to upsize. There is no limit to what you can do, right? Just use it responsibly. Don't take it because you just want to put the money in the bank and go party with the friends. So just use the money responsibly.
No, because you got to pay it back. But also, a lot of people will do the cash out refinance to reduce debt. So you can pay off your credit cards and all of that good stuff as well. I think I see a question. So let
Oh,
me.
absolutely. That's one of the biggest ones. We use it to also pay off debt.
Yes. So it says, how come the HELOC is held up by a homeowner's credit score when the goal is to reduce debt by accessing the HELOC?
So just like any other mortgage, there are credit requirements when you're doing the line of credit, right? So we have FHA, that starts with 580 FICO score. You have conventional, which is 620. The HELOC as well also have credit requirements, right? Depending on where you go, some banks are going to want to see 700 FICO score or more. I have one that I'm currently doing, the credit score is at a 651. So it just depends on where you go and who you go to. The credit unions are going to tell you no if your credit is on the lower side, right? So it just depends on where you go.
How can refinancing help someone move from owning a home to building a real estate portfolio?
My example, perfect.
Yes.
I have done it twice.
Yes.
Or a few times, maybe more than two times. First home 168, I was able to take equity out of that one, right? And I used that to buy another investment property. That property I've been holding for a little bit. I haven't taken any money from that one. But then my second home, which I bought, that property appreciated by $200,000 in year one of owning it.
Mm-hmm.
I took a line of credit on that property and then I bought another investment property. So I have been using equity from my existing properties to buy other properties. That's how you use what you have to build. And you don't have to buy one, right? Because you take $100,000 out of property that you have equity in. That's 2 down payments. And it depends on how far you stretch it or where you're buying. That could be 3 down payments, right? So equity, again, property, I wouldn't be able to save 100 grand in a year, right? Let's be fair. But when I bought my second home, it appreciated so fast that I had that equity in. And that was just the first year. The second year, I had 200 and something thousand equity in there. So, but I'm able to take that money and to buy other real estate. So that's how you see investors starting with one property and they go from 1 to 2 to 3 to 4. They're using one property. You just need to start with one,
Mm-hmm.
build that equity, and then you continue the process to build a portfolio.
And anybody can do it. You know, like we always think, I used to, when I worked at the law firm, I would have refinances come and I'm like, this person's refinanced like 10 times. Like, what is happening? And I didn't really realize I was like the person that I talked about in the beginning, where you buy your home and you think that's it. You're just going to pay off this for 30 years or whatever. Whereas now in the past few years, I refinanced a few times, well, twice to like get rid of debt and that type of thing, which is like this, you need to use your home as a bank, right? That equity is a bank and it's a resource. It's an opportunity. You know, you can use it to start a business, whatever it is that you want to do. Like you said, pay college tuition, any of those things. So talk to me, since we're on the topic of investors. Let's talk about, Mavi just put it in there too.
Brr.
Let's talk about the BRRRR method, right? The strategy that a lot of investors use in order to build their portfolio.
So again, it's buy, refinance, and you just continue the process again, as I mentioned before. I saw, well, there was something that came out about 3 months ago. The Jewish community, there was one investor that had 300 properties. And this is what he did.
Wow.
He took the cash out of the one property and he went and he bought the second one cash and he fixed it. He renovated it. And then he went and cashed out that property, refinance. So he bought, right? Refinance, renovate, and now he's going to refinance again to buy another property, and he continues the cycle that way. 300 properties. And he started with
80.
one,
And
right?
that's what it is, right? So it's buy, renovate, rent,
Rent,
refinance,
finance,
and
and
repeat.
repeat. Correct. Because that's what he was doing. He was renting the property. They were all renters. So he was holding them and then he continued the process. 300.
I think, what a question. After how many years of owning a home can someone use their home equity? Well,
6 months. 6 months. The key to using that equity is make sure that all your mortgage payments are on time. That's what the banks want to see. If you have missed payments or you're delinquent on your mortgage, you're not going to get another mortgage, because a HELOC, an equity line of credit, or a HE loan is another mortgage. And anytime you have a mortgage, any late payment within the last 12 months disqualifies you from getting a mortgage.
And so even though it's within 6 months that you're able to refinance, you don't necessarily, or you won't necessarily have equity within 6 months. I mean, some
Depends.
people do. It depends, but I'm just saying it's not always, it's not always there. But yes, if you have it, you can definitely refinance within that short period of time. Anybody have any questions about Burr or no? No Burr questions? Okay. But yeah, that is a tool that, or a strategy that many investors use in order to build their portfolio. Okay, so why do many homeowners never tap into their equity or use their home strategically?
I think it's just not knowing, right? What's available, what's out there. The question which Marlon asked is how you go about checking if you have equity in the property, right? Contact a loan officer that has the resources to tell you, hey, this is what we're seeing as an estimate. And we'll give you a range because properties appraised or valued based on their condition as well. So you have fair, good, great, and excellent. We'll give you an idea of what it's worth. You can also contact Cindy as well. She'll be able to help you, run comps and so on and tell you what it's worth. But you have to just talk to a professional so you can have an idea of what the property is worth. And again, it's what it's worth minus what you owe is the equity that you have in the property. Most banks will not allow you to take 100%. So if you have, let's say 50% equity in that property, most times you're not going to be able to take the equity out. They want to see at least 20% equity left in the property. Why? Because the market fluctuates, right? And our properties are based on the market. That's what drives the value of stocks and properties that we own.
Okay. I see another question here. It says, is it better to buy a second home to rent or sell, which is best to make more money? I think it's going to depend.
So I think they're saying to buy, to hold, or to
Yeah,
flip.
to hold or to flip.
Or to flip. It depends. It depends on whether the person is interested on just making quick cash or if you're looking to hold for long term. It depends on your strategy, how involved you want to get in renovation. I'm not going to be someone that's going to flip property because I just don't know what I'm doing when it comes to renovation, but you might have someone who is in the contractor's field or construction line of work. They're able to take properties, do it at a reasonable cost and flip that property and so on. So it just depends on you on what strategy you want to go into real estate with. Some people don't want to deal with tenants.
Yeah. So there are a few different ways. Like some people prefer to do an STR, which is a short-term rental, right? Like an Airbnb,
Airbnb.
something like that. So they're having people go in and out of there weekly, and you have a little bit more control that way than doing a long-term hold, which is like a regular rental where, you have tenants in there, and then with tenants come, the potential issues that you might have. So some people prefer to do that, but some people don't want to deal with tenants at all. And then some people have the ability to do a fix and flip type of situation. So it really just depends on your preference, your skills, your mindset, what you want to do, what you have the ability to do. But it's up to you. You can make a lot of money either way. It's going to depend on each deal. Each deal you'll have to calculate and figure out what would make you the most if you're flexible as to what you're doing, what you want to do.
Rental is more so for the long run, right? Because you're going to be making your money in smaller amount, right? Compared to when you renovate, you get all your money at once, a chunk. So it just depends.
Absolutely. Oh, here's another question. If you buy a second home, wouldn't that be considered a second mortgage and then it would be a different mortgage like a commercial?
Correct. So you can do a conventional loan. You also have business purpose type loan. We call them commercial in some sense. But yes, we can do another conventional loan for you, depending on what, you want to do, because each person have different ways and there's different products and different means to get things done. So we can do it with our tax returns versus a regular conventional loan, buying an investment property, or we do have the business purpose investment property, which is built only for investors.
Does that answer the question?
But yes, you would be taking out a second mortgage, correct? So
Okay.
just to explain or to clarify, when we
Mm-hmm.
say take the equity or the money out of the property that you have, your existing, we're saying take down payment and buy
Mm-hmm.
another one. So you might need to take a mortgage. But if you have enough equity where you can take enough cash to buy another property cash, you don't necessarily need to get another mortgage. So it just depends on where you are and the price of the property you're looking to get. The next one.
Right, because not everyone is going to have enough equity to be able to take something out to buy. You might be able to find something that needs work that you can buy fully with cash, but you might still need to get a loan in order to,
To
get
finance
the work
different.
done to
Right.
finance it. All right. So if a
So
homeowner, you have
one of
a,
the things, just quickly, Cindy, one of the
Mhm.
things that I've seen investors here in New York do, they'll take cash out of the property here in New York and they'll go into other states to buy cheaper properties, right?
Yes,
So they're
yes,
buying those in cash with no mortgage.
absolutely. So I'm working with an investor too right now. We're going to close on Monday on a property, all cash. She's buying it. She has several properties, but that's one of the strategies too, because oftentimes you're competing with other people that are buying property and they may be using a mortgage or whatever. But if you have enough equity to take something out and buy it cash, or if you've sold something and you have enough to be able to buy something else and then, invest elsewhere with the rest, putting in a cash offer, we like to say cash is king. So oftentimes when you put in a cash offer, you can make a cash offer that's usually favorable as to, waiting for someone to get their mortgage and close. So you can definitely use your equity as a strategy to put in cash offers also for a property that is fairly cheap. Let's see. Okay, if a homeowner wants to start thinking of their home as a wealth building tool, what should they do first? Like, what is the first thing you should do if you're thinking of doing this, of
You need to
using your
find,
equity, of refinancing?
I would say find out what your property is worth first, right? We want to know what your property is worth. Start there. We are also going to want to know how much you have left on your mortgage, so we can know how much equity you have in the property. And that's how we figure how much money you can tap into or how much you can borrow. I think that's the biggest thing or the first thing that we need to do.
Yeah, and then definitely, people are very careful about their credit when they're looking to purchase a house, but you still need to be careful about it afterwards because that credit is also going to be important if you're looking to refinance later on.
Absolutely. Absolutely. Credit goes a long way. That's why I mentioned before, no late payments on your existing mortgage, because then it disqualifies you from getting a HELOC or tapping into that equity.
Absolutely. And Sephora is on here. She was one of our last guests that does credit report repair if you need that. Um, is interest rate going down soon, or this is the best time to buy?
It's always a good time to buy. You're always sellers and there's always buyers. It depends on your need. We all need a place to live and every investment is going to be different. Is the market going to continue to go up? In my opinion, yes, unless it breaks. So it's always a good time to buy. We always say in this market, you date the rate, meaning it's temporary, but
Mm-hmm.
you marry the
Right.
home or you marry the property. That doesn't change, but the interest rate changes. Is it going down? I don't know. I don't. We have Mavi here. He's a financial analyst, and I'm pretty sure he's going to say the same thing. If we knew what was going to happen in the market, I would be rich. I would be somewhere else. But so many things affects interest rate. War, right? Tariffs,
Yeah.
all these different things affect interest rate. It's not just the Feds declaring, hey, we're cutting interest rate,
Mm-hmm.
but so many different things affect the market itself and what's going on globally. They look at the state of the country, right? Is it a good time to buy all these bills and to invest in the country? So every move, everything that's happening in other parts of the world that's affecting the United States of America also affect our interest rates.
Right. And it was on the decline. And yes, this particular, I guess we can call it a war, has definitely put a little bit of a pause on that. So it's then figuring out what's going to happen next. Is the money received considered taxable income?
Only if it's from the sale, right, of an investment property. If you're taking that money to invest in other places, no, because you haven't sold the property. So if you do the Burr method, but you are flipping, you're not holding, going back to the question that the other person asked, that person who is selling or flipping property has to now pay. That's taxable income. That's money they're making. But if you're holding the property and if you're taking money out to do other things personally, no.
And I did want to go back to where you said you date the rate and you marry the property, right? So again, like AnnaBelle said, it is always a good time to buy. I always tell clients, if you can afford the monthly payment now, go ahead and do it. Don't worry about the rate, because when it goes down, then you can refinance into that lower rate. But if you wait around, because what happens when the rate drops is prices go up.
Go up.
And then you might not be able to afford it, right? So if you can afford that monthly payment, stop focusing so much on the rate. Go ahead and make your purchase, do what you need to do, because if it goes down or when it goes down, you can then call somebody like AnnaBelle and refinance into that lower rate.
What I'm hearing, a lot of people are saying, I'm waiting on interest rate to drop, but it's not just you. There are thousands of other people that are saying the same thing. And when it drops, they all come back in the market. So there's a wave, a flood. And so now we're going over asking again, and everyone is bidding up these properties. So we end up in a bidding war, and we end up in driving the price of homes back up. So that's what happened when the interest rates fall. So it's always a good time to buy. You buy the property, you hold it, and then you can always refinance. Also, for the time you're waiting the 1 or 2 years on interest rate to drop, guess who's collecting all that money? The landlord, right? He's the one benefiting from collecting all that rent, while you could have bought your property 2 years ago. Now you're paying a mortgage, and when the rate dropped, then you're also getting a lower payment as well.
Yep. AnnaBelle, the landlord, is benefiting from your wait. Does anybody else have any questions?
Yes.
Go ahead.
So if you have a second home and okay, so you live in the second home, but the first home is a rental. So once you sell the rental, do you have to pay I forgot what they call it, extra to the extra money?
Capital gains.
Hmm?
You're talking about
Capital
that tax
gains.
that investors pay.
Yeah, the tax. So
Capital
how do you get it?
gains. There you go.
Capital gains, yeah. So
Yes.
there's no way around it, right?
Not unless you take the money within a certain time frame and buy another property right away. But there's a time frame that has to be done. I think it's 90 days. I don't think I'm 100% correct there, but there's a time frame that you have to buy another investment property within that time frame. Otherwise, you have to pay capital gains.
Yeah, and that would be doing a 1031 exchange.
Oh, okay. And the capital gains depends on how much the rental property.
Was sold for how much profit you made?
Oh, okay. All right. So let's say you made 100,000 off of it. Then how much capital gain? Sorry.
That's a CPA question. Honestly, that's a CPA question. I don't know the
Nick on
percentage
here,
on
no.
capital gains.
Sorry.
Well,
Okay.
I
Well,
mean,
Okay.
you
you
will be paying
answered the
capital
base
gains.
question. You answered the base question. I was
Yes.
concerned about the capital gain. Yeah. Okay. Thank you, AnnaBelle.
You're welcome, Karen.
Okay, anybody else? Because it's 6:59, so we're wrapping up. Anybody? Oh, are there prepayment penalties if I pay it off early? Depends. What happens if property values drop after taking the equity? What happens if I sell the house before the loan is fully paid?
Okay, so prepayment penalty depends on who you take the money from. Most times the prepayment penalty is 6 months. So if you paid out before 6 months, you get a penalty, but after 6 months, there's no penalty. Again, depending on the lender. If the property value drops, it drops. You already have that line of credit. But we have seen before when the market tanked way back, I wasn't around then. I was much, only
2008.
16. Um, But when the market tanked, what happened? One of the bigger bank that had a lot of line of credit was Wells Fargo, and they actually shut down the line of credit. So they're like, you can't take any more money out, right? Just pay back the money because they knew there was no equity left in the property. So that can happen if the market tanks, but we don't see that happening anytime soon. We always think positive. And then the next question, what happens if I sell the house before the loan is paid off? Then at closing,
You pay
we
it
pay
off.
off that mortgage as well.
Yeah, so when you close, when you're selling a property, you have to give that title free and clear to the new buyer. So free and clear means there's no mortgages left on the property. So you'll have to pay that off at closing. So that's going to come out of the proceeds that you're getting from the buyer. Good questions, guys. All right.
Oh, just one more thing to point out.
Mhm.
With line of credit, as you pay back, the principal also become available. Again, similar to a credit card. If you get a credit card with $1,000 limit, when you spend and you pay back that credit card, then you can go back and tap into what's left, right? The same thing with a line of credit. You get to tap back into the money as you pay down.
Absolutely. Okay. All right. Thank you, AnnaBelle, for coming on and sharing your expertise with us. Thank you again to everybody else also. Please remember to join us on April 8th for our next Talk 30 to Me, where we'll have personal injury attorney Jeff Sheetzel, who says, if you get hurt, he'll get
I'll
you
get you
money.
money.
He'll get you money.
Niche. Someone
Cindy-Lee.
asked about the how we get AnnaBelle's information.
Yes, I'm going to give it to you. I'm going to send out an email afterwards with AnnaBelle's contact information so you can reach out to her if you have additional questions. AnnaBelle, you can throw it in the chat here as well, just so they have it right now, but I'm going to send it afterwards. So I am Cindy-Lee Dorcely, your homegirl for life, bringing you the tools and conversations to help make wealth building sexy and achievable for generations to come.
I have
Because
my love language. You never asked me about my
I
love
didn't ask
language.
you the last question, but we are past time. Okay, if you had to make refinancing or equity a love language, what would it be? I forget. That's my famous last question to everyone. What love
Gift,
language would it be?
gift given. It's the
Why?
home that always keeps giving. And I know mine
Ah,
is because it has given me money and it still keeps giving because I keep building equity. So it's gift giving for
I
sure.
love it. And I think it's also acts of service, right? Because when you get out of it, you can do so many things. You can, give it to your child to put a down payment on a home. You can start a business, so many things. So I like that one though, gift giving. All right.
It gives me more properties. I love it.
This is why you're my favorite sister.
My sister's on.
She is on. Okay, so and wealth building is a relationship. So like any relationship, it deserves your quality time, your attention, and intentional conversations. So here at Talk 30, we believe those conversations are sexy and they should happen often. So make sure you're doing that at home so that you can build wealth for yourself and your families. See you next time.